love the channel and find it useful in becoming a happy retiree. Subscribe today. We are going to George, who joins us from Lake Lanier. George, what's going on? How can I help? Tell me your tax scenario.
Well, thank you for taking the call. I appreciate it. I am a retired physician, and so I've been working. I'm 71 years old. I have a home in Eddie Lake House with a total tax bill there of about $16,000 a year.
$16,000 for property taxes on your
Correct.
houses?
Correct.
Got it.
And
how much do you itemize, George?
Oh, I don't really know.
Okay, so again, when you do your taxes, do you take the standard deduction, or do you have a couple different mortgages that have a bunch of interest?
We itemize, and we don't have any mortgages. The houses are paid for.
Oh, okay. So you probably don't have a lot of itemized deductions then.
Well, just charities, probably $20,000, I would say, in charities.
Okay, all right. Let's look at this. And then no dependents, obviously, at this point.
No dependents in the home. Have about $150,000 worth of investment income a year, I think.
Okay.
And then we started taking RMD last year, and it was $200,000. So,
wow. Okay. So you have income, and then you throw in Social Security. It's about $400,000 a year.
Correct.
Got it. All right. So now some of this may change because remember, this is where individual taxes get really very specific. So if you, let's say a big part of that investment income that you have is municipal bonds, that's tax-free income, and then you might end up looking at something a little bit more specific. But let's just say it was ordinary income. Certainly your RMD is, because that's money coming out of your IRA. That's just ordinary income tax rates. So that would be pretty. That would fall in line with what this calculator is trying to foresee. Under the house plan, from what I would tell here, your taxes are going up a little bit. You'd lose about $4,000, or your taxes would go up by about $4,000. Under the Senate plan, interestingly, you would save a little bit of money, save a lot of money. You'd save about $6,000. So if you reconcile the two of those plans, George, it looks as though, let's call it for you, it really depends. It really depends. But I could see your taxes either staying flat or maybe going up a little bit, from what I can tell. Again, another. Yeah.
I'm sorry. I was just wondering, how does the married part factor in? I mean, I am married, but you said if you were single, you pay a lot more tax. The last caller.
Right. So if you were single, under both scenarios, you'd lose anywhere from $6,000 to $8,000. Your taxes would be going up. Because you are married, filing jointly. The house plan has you going down by about $4,000. You'd save about $5,600 under the Senate plan. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.